sharing super secret alpha, like super secret things. You can just, if you're afraid of a currency going down, just borrow the money and just hold the money. If the currency goes down, the amount which will get liquidated and the currency which you will have, both will be equal and you will not face the downside of the money. Which means basically, I don't want to go into details. Like it's like Ethereum goes down 50%, but you're holding $500. So that 500 and 500, you don't lose much
Got
money. Essentially, getting liquidated is a positive if you know how to use it.
Hello everyone and welcome to another exciting episode of Candid Conversation. Today we have with us a very special guest who is going to enlighten us about decentralized finance. We have with us Mr. Aravind Ujjwal, who is the co-founder at AB Nexus and DeFiVerse. AB Nexus is a crypto portfolio management company and has a proven track record of more than 5 years, while DeFiVerse is a dApp that provides decentralized portfolio management services to asset managers and investors.
Ashmeet, how are you?
Yeah, really nice to host you here. So, Arvind, without wasting any time, I would just like to know, could you explain what is DeFi and how is it different from traditional financial system?
Yeah. So I want to give you a description that's based more on my experience. I know like if anybody Googles it, they'll find all kinds of information. When I knew traditional finance, what I knew is bank, maybe take a loan, maybe invest in stocks or some gold. That's it. This is the entire my understanding of finance. What I
Okay.
understand from DeFi, I've been in the space for a while, is that it essentially gives you access to any possible financial service that you get in traditional finance, and maybe we'll go over a few, and even many which are not at all available anywhere else. And it allows you to do it in a decentralized, transparent way. In simplified fashion, what that means is that anybody can access it. It's fully open. Everybody can see everything, and all you need is a wallet. So that would be like decentralized finance. All the financial services that you can get, but without any like borders of maybe your accreditation or your financial level or the country you're in. Completely free and open to everyone. That's what I think DeFi would be.
Got it. So what are the key differences? I would say, what are the key differences and advantages of DeFi? Like, let's say, from my understanding, what I realized was like this peer-to-peer or like cross-border transaction is something that DeFi has enabled. So, what are the other key factors or key advantages that you think DeFi brings in into this ecosystem?
Yeah, I think as you mentioned, I mean, usually we mention about four or five things. Let's go the words and let's go into what they mean. So my favorite thing about DeFi for me is transparency. So one of the really cool things, which I personally am someone who believes that when we're dealing with finance, when we're dealing with businesses, transparency promotes responsibility. So if everybody can see your account book, you're not going to be doing anything shady, suspicious. So one of the things I like about how blockchain technology works is everything is visible on the blockchain. You can see the entire code of every application. If you have a little bit of coding knowledge, basically you can verify everything. So that's one of the most important facets of DeFi. The other ones, as you mentioned, are permissionless and trustlessness. Permissionless simply means no middlemen. You don't need to take permission from anyone to use a dApp. You just need internet and you need your wallet. And trustless is pretty similar in that you're not reliant on any one like a bank being open or an application being up or something. The blockchain runs 24/7 because you have miners all over the place, and it's completely based only on software application. I would say these are the basic things. Anybody can access it, and anybody can access it from anywhere at any time. All they need is a wallet, and everybody can view all the code. I admit that you need knowledge about coding, but that's one of the reasons why it's more fintech and not just finance.
Or, bro, so what are the other key features I would say, like apart from the transactions, like what are the other aspects I could include into it, like considering the transparency and all? But what are the other factors, like let's say security and like inclusivity? What are those features that how we can include them?
Of course, of course. I think that security is definitely one thing you mentioned. That's actually a little bit difficult to quantify because in the traditional space, your bank offers you security, but at the same time, you have banks collapsing nowadays. So I don't know if it's secure. In DeFi, I would say that it brings security as a responsibility, meaning that it's 100% in your hands. You learn the code, you could use good secure practices, use the correct wallet, open the correct websites. Nothing will ever go wrong. Do the wrong thing, and you're opening yourself. One of the things I believe that DeFi is very important for is convenience and, as you said, access and inclusivity. Convenience in that I was just discussing yesterday. Like I wanted to, the market was moving up yesterday. I wanted to invest into some crypto. It took me literally just 1 second. I just clicked a button I moved some assets from the left to the right, took a quick loan on it. In crypto, we often take loans to invest because it helps to protect your assets, and it's all like automated. And it took me literally just 1 second, and I wanted to invest into a new protocol on a new chain. With 2-3 minutes, 2-3 transactions, it was done. So I think that
Right.
convenience is extremely like valuable and not at all available anywhere else.
Got it. So, like, I just have one question. When we talk about security, like, there are a lot of exchanges, right? Like, one is decentralized, but in the present scenario, I saw that like Binance was sued by SEC for like I would say like I'm not sure about the exact reason, but Binance was sued recently by SEC, and like
Yep.
that's a centralized exchange. So like that poses a lot of risk for all the people who are involved in this sector, right? Because let's say Binance goes down, a lot of people are going to face the burns that are going to come along with it. So how can a person or a general person who is getting into DeFi or who is investing into crypto, how can he be secure? Because otherwise, if I'm investing through Binance, it's similar to what I'm like. It is similar to the financial ecosystem I'm presently in. So how
Yeah.
can we differentiate it from that?
Yeah. So you've made an honest point. First thing, I don't want to suggest anything irresponsible. There are ways where you can just do P2P transactions, you can do all these, but as an organization, as a firm, I think that the point of crypto is not to go against the current systems but to enhance it. So
Right.
we'll see how the regulations and all these things go in the future. Let's see how the world accepts crypto, the governments. But in to address your actual question, this is a crucial point that most of us are focusing on, which is how do you transition from a Web3, like you have money, how do you get into crypto safely? So the
Right.
first thing is, once your crypto is in your wallet, it's only yours. Nobody can do anything with it. No one can take it away from you. Specifically, if you buy a hardware wallet, which is like a small pen drive, then you are absolutely secure. But you are right that to get the your first rupees or your dollars into the crypto, you have to go through some intermediary. Nowadays, we have
Right.
many other ways to get money. We have on ramps and fiat exchanges like Transact and one more is there. It's not coming to mind right now, which means that we're not entirely reliant on centralized exchanges. We also have like WazirX, which is right now maybe shutting down their P2P. But for the last 3 years, we ourselves have used a legal P2P thing where you have a transaction between two people, but it's fully on chain and recorded. So while we
Got
may
it.
not be able to control the government sentiment, by using the correct softwares and getting your final finance onto your wallet, you should be safe. That first step definitely is a little bit of a tough challenge.
Got it. Got it. So, like, as we talked about cryptocurrency in DeFi, like, what's the role of crypto in basically this DeFi ecosystem or DeFi space? Like, how is a crypto contributing to the growth or like is building up of this DeFi space?
Yeah. I was talking to someone yesterday that we were discussing what is a cryptocurrency really? Is it a currency? Is it a digital data? What is it? And we came up with a nice example that a crypto is like a stock, a currency, and like a VIP pass all bundled into one thing. So the meaning of it being a stock is that you gain ownership of a part of a protocol. So let's say DeFi is like application, right? Like let's say Facebook. Facebook is an application that allows people to do things. ICICI is an application in one sense that allows people to do banking. Like this, we have many apps in decentralized finance. So it's a stock in that you own a part of the app and you're entitled to some revenue from the app. So it acts as a ownership. It acts as a currency in that in the space, many people will accept it and it'll allow you to transact with it. The most cool part about cryptocurrencies is they act like a pass in that if you're using a particular cryptocurrency in a particular way, it allows you access to bonus features or features that are not available without the currency, like a discount or an increase in rewards or a reduction in fees or even just access to various services. So cryptocurrencies are an integral part of DeFi. They are in fact, if DeFi is the infrastructure, cryptocurrencies are the thing we are moving around. So it's
Got
basically
it.
the money, but it's also very functional money. So it has multiple utilities.
So, like, what I'm going to ask is a bit from technical perspective, but I would still like to know, like, when we talk about crypto, and as you mentioned, that crypto is a major aspect that we are moving around in DeFi. Uh, what kind of financial services or transactions are actually happening with this crypto? Like, how are we actually integrating crypto into these transactions?
So first thing, I just want to make a quick side point before going into your question. Currency, they're basically just data, okay? Like how when you open your bank balance right now, you just have a data that says 40,000. The only difference here is nobody can change the 40,000. So it's kind of very structurally prevented because of some technology thing, blockchain technology. We'll not go into that too much. But to answer your
Right.
question, the nature of decentralized finance is that through many, many years of interoperable communications between dApps, what I mean to say is that all of these people have come to a consensus using automated code and on some level human trust between each other to say that, hey, I accept Ethereum, you accept my coin, I accept my coin. Most of this is written by code in one or two places vetted. What this means is you have a ecosystem of close to 100, 200, 500 applications. Most of these also has individual coins. All of them are functioning in a safe where they all say that the other currencies are trusted, which means if I want to perform some task on your application, let's say your
Right.
application is a application that gives loans. So your
Right.
application has a deal with Ethereum that says, bro, even if you put Ethereum, I will give you money. I will give you whatever dollars you want. So
Got
in
it.
this operation between all of these DeFi, the cryptocurrencies help to foster different activities like taking loans, giving loans. You can swap currencies. There are even cool things which are not available in traditional finance like staking, yield farming, liquidity
Right.
providing, and things like that. So
Got
those are the kind of things you can do using crypto in DeFi.
Got it. So you mentioned about loans. So like one thing that when I talk about or when I study about financial system, one of the major terms that we come across is lending and borrowing. Basically, the credit cycle that goes into the financial system because that credit cycle is basically running the financial system at the present time. So how does this lending borrowing thing happens in crypto? And once you answer this, I would also like to know more about liquidity mining. Like, what is this liquidity pool about? Like, basically, that is what I want to know.
Absolutely. First thing, I want to be very honest and share actual numbers. So before I share the numbers, okay, not financial advice and all that, because you have to be responsible and results vary. So first thing is lending, borrowing. The nature of it, how it's done in DeFi is first thing, it's always over collateralized. Over collateralized means if you put in, and it's always collateralized. You don't get loans based on credit and all. There are some new companies doing that, but we'll talk about the general. Which means if you put in, let's say, 10 lakh as collateral, you can only take a 5 lakh loan or a 7 lakh loan maximum. Secondly, the liquidation. What this means is usually you put a currency as collateral and you borrow another currency. So let's say you're putting Ethereum for $1,000, you borrow $500. If Ethereum price comes to 500, they will just take your Ethereum, sell it on the market, and pay back your 500. Which means there is no risk to the ecosystem. Okay, you may lose money, but you'll never see these kind of bank runs where millions of people are just getting ruined because the banks had lied to everyone. So all of this lending and borrowing is happening completely in an automated way. So if I want, I can go and lend my currency there and earn a very reasonable interest, like 3, 4%, 2%. It's a little bit less, but it's much more than what you get in the normal market. Or I can
Right.
borrow and I can pay that interest of 5, 6%. If I don't pay the interest, they will just take your money and pay it back. So it's very honest and safe. So
Okay.
that is about
Got
lending
it.
and borrowing.
So just one question that pops up in my mind when I listen to this. So like let's say if I want to take a loan of 100,000 or I want to take something like I put up a collateral and the value of that collateral goes down because collateral is definitely going to be a crypto or some non-fungible
100%.
token kind of stuff. So let's say
Yeah.
if the value of that asset goes below the market price within that specific time. So is my asset going to be sold automatically and I do not have any chance to like wait for the time period for which I have taken the loan and repay it? Or how does that cycle works?
Yeah, so there's no time concept here. As long as the loan is there, you have to pay the interest. If the value of the collateralization ratio goes below the amount you have borrowed, they will take it from you. So it is definitely a thing where you have to be responsible. There's nobody's going to protect you or say, one day you don't pay and all. If it goes down, it's liquidated because the key is to protect the lender's interest more than the borrower's the borrower's interest. They say interest meaning, I mean, the lenders are the one who are keeping the system safe. So the lenders always must be protected. So you'll be liquidated on your own. I think that's not a bad thing. That just means that you don't worry about your loan. You just focus on your work. It's okay. You're not going to face anything except like, see, if you're borrowing the money, you're accepted that your collateral may come down. In fact, one of the
Got it.
strategies, and now here I'm sharing super secret alpha, like super secret things. You can just, if you're afraid of a currency going down, just borrow the money and just hold the money. If the currency goes down, the amount which will get liquidated and the currency which you will have, both will be equal and you will not face the downside of the money. Which means
Got
basically,
it.
I don't want to go into details. Like it's like Ethereum goes down 50%, but you're holding $500. So that 500 and 500, you don't lose much
Got
money. Essentially, getting liquidated is a positive if you know how to use it. You use it to
Yeah, like,
prevent the currency going down.
right. So like that's what comes to my mind. Like let's say if I borrow $500, like taking $1,000 worth of Ethereum. Now let's say the value of Ethereum goes down to like it is going down and it is going till 400. So my Ethereum is going to get liquidated at 400, right? Like while I still own that 500 with me. So there is
Exactly.
a huge possibility that I can buy the Ethereum from the market all over again from 4,000 and I still have that 500. So
Yeah.
that basically balances it out and I can actually use it as an arbitrage, right?
Exactly. Exactly. You actually need to use these lending and borrowing liquidations to your advantage. It's not a bad thing.
Got it. So basically, like bringing in the arbitrage or arbitrager is the main game here.
Yes, yeah, that's one of the uses. I'll be honest. There's a recent thing where here I'm not shilling the action of the person. The founder of Curve and Convex Finance, a famous company, just put $80 million of his own Curve, took a loan of 50 million, and recently USDC depegged by 5%. He just took $50 million. It came back up. He paid it back. He just made 5 million in 2 seconds. So, if
Got
you
it.
have confidence in the system, literally, I think it took 20 minutes. He just took a loan of 80 million. Currency moved by 5%. He paid it back and he made 5% of 80 million. Just like that.
That's really, I would say, amazing stuff. So when I talk about making quick money in here, so I have seen a lot of people actually getting into this trap because I would say there is lot of like there is lack of proper knowledge circulation about this space, and people don't actually understand the terms of protocols that are actually taking place in here. And one thing that I like recently encountered was what liquidity pool. So basically, someone actually put all his money into the liquidity pool, and that liquidity pool actually like it was not a famous coin, but that
He got robbed.
liquidity pool
Basically.
actually ran away with all the
Correct.
like
Correct.
matic. So now that person is actually doomed with it. So what kind of
Yeah.
stuff could be done in here, and what is the safe way to play around in this segment?
So just to give a quick background, I've been a crypto hedge fund. So
Right.
one of the things we try to do, and I think this is very important as an investor, be more conservative in the crypto space and the traditional space also. Be patient and be slow. The nature of this market is that even if you buy the most boring coin and don't do anything with it, like imagine you just bought one Bitcoin and simply sat still. Literally from last week to today, you would have made 10 to 20%. The
Got it.
problem is when people come here, they get over hyper, they get exaggerated, they want returns now. You have to gain that discipline of being patient, investing in the best coins, and if nothing is happening in the market, simply wait. Okay. So that is the first thing. Don't invest seeing the APR. Every liquidity pool will show you 20,000%, 30,000%. The higher the APR, extremely likely that it will not last because these are all based on maths. This is not magic that you're dealing with. If somebody is showing 20,000%, 2 days later it will be 20%, and you'll be wondering why am I holding this random coin? Basically, I'm
Right.
saying if you don't understand the protocol, don't invest. If you're not sure what
Got
to
it.
invest in the top three, four coins, relax, liquidity pool and all, do some research on it. I'll give an honest suggestion. I am using a liquidity pool right now of Ethereum and US dollar because I am
Right.
okay. The nature of a liquidity pool is that you will often end up with one of the two coins, lot of them. You may put in
Right.
500 Ethereum, 500 US dollars. If Ethereum gets rugged, you're going to end up with 50,000 only Ethereum. Your US dollar will go off. I have confidently
Right.
accepted that both these coins are okay, and I'm earning a very good yield. I'm easily
Right.
earning like 0.2, 0.3% per day. It is a very, very
Right.
high yield. But this is some,
Right.
I know this protocol because I've been in the space for 7, 8 years. I'm actively managing my position. I monitor it every day and I am ready
Right.
to lose the money. That is one important thing. I will not complain. I've come into the space not investing my salary or something. It is like,
Right.
that is one of the things in crypto. Don't invest if you can't afford to lose it because it's experimental and it's new.
Got it. So it's more of like experimentation that we're trying to do into this space like that.
It really is. You're balancing between what is safe and what is lucrative. I honestly learned that if you simply don't lose money in crypto, you'll end up making immense money. Just don't lose, just relax. Basically, if you just buy the coin, don't go buying some random meme coin, some this coin, that coin, this cool, nothing. Just hold the coin. You will make so much money. You'll be like, oh my goodness. Just chill. Just buy one Ethereum and just hold. You will be up 10x, 20x. But I've seen it so many times.
Okay. That's really interesting, I would say. So what I want to know more about is like what is liquidity mining? That was the question that I also have.
Correct.
So like let's say you also mentioned that you're earning an interest of 0.2, 0.3% per day. So what is liquidity mining and how can an individual, I would say a naive individual who has no idea about crypto, how can he actually really explore that place?
If you don't mind, I'll go into a brief explanation. Right now, if you go on the forex market, Western Union, you go there, you give your dollar and you get a rupee. who is deciding this rate? Where is this rate coming from? It's just some number we see on some billboard. In the background, what is happening is there are people who are putting millions of dollars, millions of rupees, and you are exchanging between them. So when someone takes from the market, which is called swapping of crypto, somebody has to make the market. Meaning, I have to say that, boss, you want dollar, I'll buy rupee. I'll take a rupee and give you a dollar. You want rupee, I'll take the dollar and give you rupee. Which means I'm always taking the worst side of the deal. The service I'm providing is called liquidity providing. I'm providing the liquidity for you to trade in. The fees that I get is when you buy a token, if you give 100 rupees, you will not get 100 rupees worth back. You'll get 99.5 worth back. That 50 paisa goes into my pocket. So this is the concept of liquidity providing. It's in the traditional finance, it's called market making. This is one of the most novel features of DeFi that random users can just go and automatically provide liquidity to the platform and earn fees. This is actually my favorite, or I'd say top two favorite crypto things that you can do. So how it
Got it.
works is you provide 50-50% or rarely some different ratio of two tokens, let's say Ethereum and US dollar. If anybody
Right.
comes there and swaps between Ethereum to US dollar or US dollar to Ethereum, you're getting the fees. That's how it works. And usually the fees is, if you know which protocol and how to do it, very, very, very healthy. Which means I would say 15 to 20% is baseline, and based on how you do it and how well you do it and managing the liquidity, which is like you have to like mathematically say that here I want to do a lot of liquidity, here I don't want to do a lot of liquidity. If you know how to do it, it's called range bound liquidity. You will be earning easily upwards of 40-50%. I know these numbers sound very like too big and it's very like hyper unreal, but it is something as a conservative investor I'm telling you, because I'm a very conservative investor in the space. I'm not going into any risky coins. I only hold Ethereum and all. Yeah.
Right. So, like, being a conservative investor, let's say if I want to be that, like how important is due diligence and what kind of research is required from my end? Like, what are the few points or aspects that I should keep in mind while I'm investing in? Like, obviously, like not being greedy is one aspect because, like, recently what I saw is like there is a coin called Pepe coin, that's a meme coin, and few of my known people or few of the people on social media have posted that they turned out millionaire by just investing few thousand of bucks. Like that was like I would say more than 10,000% of return. So that is like I would say massive return for anybody who's investing into this space. And considering that I'm coming from a conservative, normal, or I would say Web2 investment space, that kind of return is actually can make anyone go crazy. So what
Correct.
are the points when I should keep in mind? Like what are the pitfalls or what are these due diligence that I should always keep in mind and those points?
Yeah. So the first thing is, this is the thing I want to start with because everything else will go against these meme coins. You might actually make money in all this if you get lucky. I'm not going to deny that. You hit the right. I'll tell you one thing, Ashmeet. There's a software called Dex Tools. Okay. There is roughly one coin being made every second.
Right.
There's a new crypto being made every second. And there's probably more being made. So
Right.
what are the chances here? You can play your luck. You can gamble if you feel like. Most people actually are misunderstanding that it's not a technology, it's a gamble. Literally casino jaane se pehle, they're just going and buying some crypto.
Right.
I would say that forget due diligence and all. If you don't know what it is, don't buy it. If you just simply explain this, and other advice is, if the currency has not been around for 6 months, don't buy it. Why I'm saying this is, in 6 months, if it's a scam, they'll run away. If it's getting hacked, it'll get hacked. Basically, patience, just very slow, simple, understanding based investing. I buy the coin because I understand the protocol. I study the smart contracts. I go over the audits. Professional firms audit the smart contracts. I notice the founders. And if I think that I am getting gambling, like if my mood is gambling, that day I will say, I don't want to buy any coins. It's okay. Basically, this is the best advice I can give you. It doesn't matter how much you make, it only matters that you don't lose money. So don't buy
Got it.
meme coins. I mean, it is my honest advice. People have made money in meme coins, okay, but
Right.
don't buy all these coins, because all these things of social media things and all you see posting, they're all lying to you. Openly, I'm
Right.
telling you, everybody will post his victories. Very often, they will not post the correct screenshot. And if he has bought one meme coin and succeeded, he has probably bought 1,000 and failed, which he didn't tell you about. Don't
Got
listen
it.
to all these stories. Live in fundamentals, basically.
So, like, would you suggest any DeFi protocols or like places or DeFi platforms which as a starter or like a person who's getting into the space should explore or should learn more about so that I actually am aware of how I can invest into crypto or learn more about it?
Absolutely. I will start with the basics. The first step is to get some crypto in your wallet. So I would suggest to start with either Ethereum, Polygon. These would be the safest tokens to start with because they are the oldest coins, the safest coins, and very, very well, like everybody trusts it. If you ask anybody what are the blue chip coins, everybody's going to say Bitcoin, Ethereum, Polygon, maybe now Arbitrum. That's it. There's only four on Binance, BNB, that is. Not that Binance coin. Binance chain is different from Binance. Anyway,
Right.
so I would suggest first step is load up your wallet with some Ethereum, either through the centralized exchange, through Transact, through Fiat. Okay. The first activity someone can do is just stake your Ethereum. I think it's very good for a person to just click the stake button, Ethereum Polygon. You earn between 7 to 9% depending on what the market is, which I think
Right.
itself is very impressive. If any, like,
Right.
crypto is not currency, it goes up also. It's like a stock. If people are to tell you you're
Right.
getting 8% dividend on a stock, trust me, a traditional investor would come here and invest millions of dollars. 8% is a big number.
Right.
I think this is the
Right.
first. Now, on top of that, what you can do is you can go one step extra and maybe take the like a nice pool which I like to invest into would be like a staked Ethereum liquidity pool, which is basically you're just taking the same staked Ethereum and trying to earn little more compounding rewards on it. So your
Got it.
9% would become like 14, 15%. You must again use the most blue chip protocol. So Uniswap, Beefy Finance, Balancer, Quickswap. If I'm naming these, it becomes difficult because there are many which are safe and thousands more which are risky. It's tough to name all.
Right.
I would say, it genuinely, I would say that people should contact a professional or research a lot before investing. I would say the next step would be invest in a very safe pool like that, earn 20, 15, 20%, learn it, feel the market space, then research. Some of the more
Right.
newer liquidity pools and interesting things are like protocols like GMX and GNS, where long story short, traders are betting whether Bitcoin goes up or down, and you are betting against the traders. And these
Right.
protocols, they're relatively new. They're only 1.5 years new, which for me is still new. They have shown very nice and interesting ways to provide liquidity, where you'll be holding Ethereum, Bitcoin, all these coins. You're earning roughly 15, 20% on them as well. Like
Right.
this, you slowly expand your knowledge. Most importantly, be patient. The market will go up 80%, the market will go down 80%. Guaranteed it's going to go up 5x. Guaranteed you're going to see it come down 5x. When it goes down, try to buy. When it goes up, sell. Don't worry. Don't be holding till it becomes $1 million. I would simply say if it goes up 50%, sell 5%. Goes up 100%, sell 30%. Goes up 210%, just sell 80%. Relax. Take your profits. Feel that success of your investment. Don't just be waiting.
Right.
These would be the advice I would give.
Right. Uh, that's I would say like that's really going to help me out and all the people who are actually going to listen to this podcast. And just one last question before we end this. What are the few trends or opportunities that you feel are coming into the DeFi and you really believe in? Like, could you highlight some trends or opportunities that we should be focusing upon?
I'm going to name two to three very, very, very big trends in the last year, which we as a hedge fund also have really, really been successful of. The first would
Right.
be real yield narrative. So what this means is there are protocols where people come and do random things. They trade, they do options, they do this, they do that. You are saying,
Right.
bro, you guys make your trade, you guys gamble on Ether goes up, Ether goes down. What I want to do is I want to hold the token of the protocol which is offering the service, and I will take a percentage of the fees that they earn. So this is called real
Got it.
yield. They are not just offering you new coins, they're not shilling anything.
Right.
They're actually offering you percentage of real yield every day of the fees
Right.
between people. This narrative is extremely lucrative. First thing, if you're buying a token which has good real yield, meaning that if the token is worth $1 and in a year you're earning 20 cents, 30 cents, from a traditional space, that's an extremely good risk to return ratio, and the token will likely go up. So
Right.
examples of these would be like investing in the currently the Arbitrum ecosystem is booming. So like I said, GMX, GNS, Trader Joe, these would be the synthetics. Synthetics is a more new one. These are the current leading people in the real yield narrative. So you buy their coin, you stake it, you are not risking anything, you are not gambling, you are earning a fees from the entire protocol. This is the first narrative.
Right.
The second narrative, which again is extremely new and booming like crazy, high potential, is real world assets. So right now
Right.
it's a not so new, but it's picking up now. You can buy land using crypto, you can buy stocks using crypto, you can buy commodities using crypto, you can buy fractionalized renting of like big apartments using crypto. So they're cutting the apartment into 1,000 parts and you can earn rent. You're literally getting exposure to land using crypto. Here also the same thing. Buy the actual land, Buy the protocol that offers the land, because you will get a
Got
percentage of the yield. So I believe in this concept of investing in services, not in commodities, because they will keep giving you profit in the future as well.
it.
Another important narrative is recently Ethereum switched from proof of work to proof of stake. What this
Right.
means is staking Ethereum has become a very big deal. So you have a new wave of narratives called liquid staking derivatives, where, if you remember, we have spoken about staking Ethereum. You stake the Ethereum, but you get back a token which you can again use in DeFi. You get a liquid staked thing. So even though the Ethereum is supposed to be locked, you can use it again. These protocols are catching fire. The
Right.
the oldest one and the most basic one is Lido Finance. That's the biggest. But you also have new players like Libra and Raft and these protocols coming in. These are the three trends which are going very, very, very high, and these are stable trends. You also have
Right.
narratives like meme coins, which surfaced last year. You have gambling protocols where you're not gambling. You're providing the house edge. So you provide liquidity, other people gamble, you just take the fees.
Got it.
But these narratives are a little more new. AI narratives are going on. But I would suggest that stick to real yield, stick to liquid staking, and stick to liquid real world assets. These are the booming narratives in the space, and these are definitely very secret in that not many people know about all these things. You have to be in the space to know it.
Right.
So it's definitely good things for people to explore.
Right. Uh, So yeah, that was like I would say really insightful for all of us, like for me and all the listeners who are going to listen to this. And I would really like to thank you, Arvind, for coming up on this podcast and like sharing so many beautiful insights with us. Thank you so much for coming.
Thank you, Ashmeet. I hope to be here more. I really enjoyed the podcast as well. Thank you for your time.